All right, let's dive in. If you're tired of just riding the crypto roller coaster and hoping for the best, you've come to the right place. We're going to break down how to stop guessing and start building a real professional grade strategy to navigate this market. Let's get to it.
You know that feeling, right? The crazy volatility, the whiplash from the price swings. It can feel like you're just adrift in a sea of noise. One day you're a genius, the next you're not. It's tough to know what's a real signal and what's just, well, chaos.
Well, you are definitely not alone in feeling that way. But what if I told you there's a map for this madness? That's what we're here to do today, build that map. It's about making that shift from being a passenger to being the pilot of your own ship, armed with a real framework for making smart decisions. So, first things first, before you can navigate any landscape, you gotta understand its seasons. And in crypto, that means getting a grip on the market cycle. And look, this isn't some abstract academic theory. This is the fundamental rhythm that absolutely everything else is built on.
History shows us that the market basically tells the same story over and over again, moving through this four-phase cycle. You've got accumulation, then growth, then the crazy bubble phase, and finally, the inevitable crash. The goal isn't just to spot these phases, it's to use that knowledge to master your portfolio and maybe even more importantly, your own emotions.
Let's be crystal clear. The accumulation phase is where the real money is made. Prices are in the basement, pessimism is everywhere, and most people have given up and gone home. This is the quiet before the storm, and it's exactly when the smart money starts scooping up assets for pennies on the dollar. And then you have the polar opposite, the bubble phase. Oh man, prices are going vertical, your cousin is suddenly a crypto expert, and the vibe is just, it can never go down. This is when you'll see things like the Fear and Greed Index screaming extreme greed. It's the classic flashing red light that euphoria has taken over and the market is on thin ice. And after the party comes the hangover, the crash. We're not talking about a little dip here. These are major gut-wrenching corrections. In past cycles, we've seen assets drop about 80% from their all-time highs. Now, knowing this isn't about being a downer, it's about being a realist. It's about being prepared, both with your money and in your head, for the entire ride. Okay, so we've mapped the terrain. Now, how do you actually steer the ship through these stormy seas? This section is all about actively managing your portfolio. It's about protecting yourself on the way down and setting yourself up for success on the way back up. This is where the real work begins. So one of the most critical tools in your entire kit is the stop-loss order. Just think of it as your automatic eject button. You decide on a price beforehand, and if things go south and your asset hits that price, the system sells for you. No emotion, no hesitation. It's just a simple, powerful way to protect your capital from a free fall. But here's the catch. Setting a stop loss is kind of an art form. If you set it too tight, a totally normal market dip could knock you out of your position right before it recovers. But if you set it too wide, well, you can end up taking a much bigger loss than you wanted to. There's no magic number here, just a calculated decision based on how much risk you're willing to take. Playing defense is absolutely crucial, but a pro strategy is just as much about playing offense. So let's pivot a little. Let's go from just preventing huge losses to actively squeezing out better returns with a really powerful technique called rebalancing. And hey, don't just take my word for it. Let's look at the hard data. There was this academic study that ran a massive simulation. We're talking 10,000 different crypto portfolios. They wanted to know if actively rebalancing your portfolio actually works. And the results? Yeah, they were pretty loud and clear. The whole thing really came down to this one number, a p-value of 0.005. Now, don't let the stats jargon scare you. All this means is that the results are highly statistically significant. In plain English, the better performance from rebalancing wasn't just a fluke, it wasn't random luck, it was a real, repeatable edge. So the big takeaway here is that in a market that moves as fast as crypto, you can't just sit on your hands. The study found that making frequent adjustments is key. While daily rebalancing was the top performer, even just rebalancing when things drifted by 5 or 10% crushed a simple buy and hold strategy. The data doesn't lie. Being an active, disciplined manager pays off. All right, you get the cycle, you're managing your risk. But there's one final hurdle, this unavoidable toll on the road that trips up so many investors, even the pros: taxes. And thinking about taxes isn't something you can just put off. It has to be baked into your strategy from day one. So, at a super high level, your crypto activities usually fall into two main tax buckets. You've got capital gains, that's when you sell something for a profit, and then you have ordinary income, that's for stuff you earn, like staking rewards or airdrops. Seems simple enough, right? Wrong. The reality of DeFi is not simple at all because it gets complicated fast. I mean, just look at this list of totally normal, everyday DeFi activities that are all taxable events. Every single one of these, providing liquidity, wrapping a token, bridging to another chain, creates a distinct tax situation that you have to track. It's a minefield.
Let's make this feel real for a second. Let's say Sarah lends out some ETH and earns 2 ETH back in interest. Okay, simple. But wait, the price of ETH shot up while it was loaned out. So what's her taxable income? Is it based on the price when she got it, the price when she earned it? See? It's a total reporting nightmare. And if you think I'm being dramatic, just listen to this quote from tax pros who live and breathe this stuff. They're not exaggerating. The sheer number and complexity of DeFi transactions mean that trying to handle this on your own isn't just hard, it's a massive risk. Seriously, this is your wake-up call. So we have covered a ton of ground. We've looked at the terrain, we've talked about the navigation tools, and we've covered the tolls you have to pay. Now let's bring it all home and put it together into a clear, actionable playbook that can take you from just being a participant to being a real strategist.
Here it is, your path to pro, boiled down. 1. Know the 4 market phases so you can master your motions. 2. Use your defensive tools, like stop losses, to protect what you've got. 3. Be proactive. Let the data guide you to rebalance for better returns. And 4, the one nobody likes but everybody needs. Plan for taxes from the very beginning.
And just remember this, the difference between an amateur and a pro isn't about perfectly predicting the future. No one can do that. It's about having a strong, durable strategy that can handle whatever the future throws at it. You now have the framework for that strategy. So the only question left is, are you ready to use it?